Hello and welcome to the November edition of Making Sense with the Markets with Team LWC and myself, Chris Kerlow. Thank you for joining us today or watching the replay on YouTube. Here's our standard disclaimer slide. So October got off to a bit of a bumpy start following a rough September for markets broadly speaking. Fortunately, we saw a nice repeat rally as we came into the end of the month. We had a nice reduction in the US dollar as the euro, JGB, as well as the British pound strengthened. All eyes obviously have been on inflation numbers over the past several months and will continue to be as we move into the November 10th announcement of the US CPI data. Another big day tomorrow with the Fed announcing their rate hiking regime. We saw the Central Bank of Canada increase rates by 50 basis points, but in the earnings momentum and earnings calls that we've seen so far to date, it has been a pivot away from supply chain woes to US dollar strength and the challenges that has been for companies around the world. You can see in our last bullet point here, we described the US dollar has a negative 0.9 correlation as of late to equity markets, meaning that that's when the US dollar is up on a day, the stock markets tend to be down. So that rally that we've seen in other currencies over the last couple of weeks has certainly been a bit of a relief, broadly speaking, for markets. This recession is likely to be considered an earnings-based recession. We have seen expectations for earnings growth declining. Q4 is expected to be lower for both the TSX as well as the S&P 500. And you can see that in the chart here on the top right. Expectations in the low single digits is something we haven't seen in a long time. Following the great financial crisis, we had a decade of rapid earnings growth. And now companies not only are reducing their earnings, but are also being punished quite hard when they do. You can see that in the second chart where companies missing earnings expectations has continued to fall kind of off a cliff here. And when those misses are taking place, those companies tend to be down quite badly on those days. The good thing with earnings-based recessions, historically, they've lasted about 15 months. We saw the peak for the S&P 500 11 months ago. The TSX peaked 7 months ago. So there's a good chance that we're largely through a lot of this volatile storm. One thing that tends to be associated with stock market bottoms tends to be a blowout in volatility. We're charting that here on the bottom right slide with the blue line being the volatility in the stock market index. It really hasn't seen a spike like we got back in March of 2020, but we have seen a volatile move up higher in the MOVE index, which is the volatility of the bond markets. We've seen extremely volatile both bond as well as fixed income markets, and believe that, with the fight of inflation, that volatility there could be the sign of the bottoming that equity markets look through towards. So it's a bit of a complicated situation, but when you couple that with declining US dollar strength, we do see a bit of an opportunity for markets to see an end in sight. One of the things that we're keeping an eye on has been a reversal in inventory builds. You see in the chart on the top right here, the average sales to inventory ratios are ticking up quickly. What that means is companies are selling less goods versus the inventories that they're stocking. That does tend to take several quarters to normalize and varies very much by industry. But we are seeing companies start to get a little bit punished for growing inventory gluts, such as Walmart and Target, and their most recent earnings releases definitely took a step backwards after talking about that buildup. The solution to an inventory glut happens by one of three ways. One is just simply write-offs. The second is keeping prices high and selling basically an insufficient amount of units. Or the third and most likely situation is cutting prices, which can roll through to lower overall inflation, a positive that we see taking place in the markets here today. One of the ways we're looking at combating high inflation and a challenging equity market is dampening that volatility with dividends. Historically, when you've seen above trend inflation like we have today that is falling, you tend to see an outperformance in dividend paying names, particularly those with very high yields in defensive sectors. This has got us bullish on this area of the market. Broadly speaking, the new market leaders of the next regime, meaning coming out of the back of a recession or a bear market, tends not to be the leaders of the last one. And we saw the tech-heavy S&P 500 with what would be called Fangman, Facebook, Amazon, Netflix, Google, NVIDIA, Microsoft, and Apple definitely lead the results for a long period of time in those indices, making it very challenging for active managers. If you didn't have a large exposure to that cohort, it was very challenging to outperform or even keep up with the market, picking any of the other 493 names in the index. However, we believe that this pivot and new leadership in value, high dividends paying names will once again bring a return to active management. We've reduced our overall passive exposure in the Team LWC portfolios and leaning more into active management, concentrated in high dividend paying sectors. This is the LWC Canadian High Dividend Portfolio, highlighting the names that we own and like at this point in time. Obviously, it changes from time to time. The dividend yield the start of last month was a little bit above 5%, but because of the rally in a lot of these names, we've seen that creep down just below, but still offering a healthy 4.5% dividend yield, which can definitely help dampen some of that volatility should things move sideways or lower from here. We still have some of that protection. And then because the average dividend growth rate is over 9%, it does help the portfolio keep up with inflation. And this is available exclusively to LWC clients. Should you like more information, please reach out to Matt Langsford or myself. We'd be happy to walk you through our methodology of stock selection, oversight, portfolio management, and rebalancing activities. And with that, I'll wrap it up for today. Thank you.